Mark Matthews then on the show with us from Julius Baer. Mark, hi, good morning. Good to have you in the show. We were just looking at the FI activity, Mark. While, of course, the Indian equity markets have gotten into a bit of a rough patch since last week, why are FIIs selling India all of a sudden? In the last 1 month alone, we've seen about almost 10,000 crores worth of equities getting sold.
Well, it's been the second best performing major equity market in the world after Russia. And so I think people are simply feeling it's gone up too much and it's expensive. And I noticed a couple of the investment banks downgraded the rating in order to upgrade their rating on China. So there's a shifting perception that China has bottomed now and there's value in China. And that, I think, would explain the selling.
Sure. Having said that, Mark, the one commentary or the one factor which remains key and constant across many sectoral categories as we're in the thick of, the second quarter earnings performance as well or updates, is that inflation really has, marred the margin performance for most of the companies. While some of them, of course, which have been, consumption facing, have managed to pass it off to consumers like paints as a category or pure play FMCG, but many others haven't. How is it that you are looking at inflation at one hand, and whether or not we will see the, central bank in a hurry move on from being a growth propeller to an inflation warrior?
Well, there are a lot of moving parts to that conversation because you've got the COVID rebound, which is clearly causing a lot of supply chain bottlenecks in the sense that, there's been a big economic rebound in many parts of the world, but other parts of the world are still suffering from COVID or very worried about COVID. Particularly China, they're paranoid about COVID because their vaccine efficacy is low. So if Delta ever really got into China, given the size of the cities and the population density, they'd be in trouble. And so they're keeping their borders sealed and commensurately their port activity is much lower than it is usually. And then there's wage price pressure in many countries because people have dropped out of the labor force. I think COVID has been some sort of epiphany for a lot of people that maybe I should do something else with my life. I didn't really like my job. And they can see that there are definitely wages are rising. So they think if they wait, they'll get a better job. Indeed, it's true. You can see the wage increments for people who are switching jobs are at their highest, I think, possibly in the history of the data series in America that goes back to the 1980s. Anyway, I could go on and on. There's so many. And that the ESG, by the way, the ESG, which is putting pressure on the supply of oil and coal globally. But I would say that if you look at, the Baltic Freight Index, for example, that's rolled over sharply. So has the price of coal in China. So has the price of natural gas in the UK. So I do think that either prices get to levels that are simply too expensive and people buy less, which naturally takes the edge off, or there is a supply side response, and a supply side response is possible in virtually anything. The Chinese can buy a lot more coal from Africa and Australia if they want to, for example. So it's a very complicated conversation. I think even if inflation proves to be longer lasting than the central banks anticipate, you're still better off in equities than bonds. I think the equities will be able to withstand it much better.
Okay. Mark, while there is merit in perhaps comparing India and China, one at the top of the heap, other at the bottom of the barrel, but given that there are fundamental changes in the economy, in the way how the Chinese government now wants to control may not be a good word, but in terms of the ideological change in how they are looking at conducting country's economy, do you think the shift from China to India will be more like a permanent one, whereas you may see periodic corrections in India and periodic upticks in China, but ultimately the money is not going to migrate into China in a big way?
I do. So we're not in the camp that China is a buy. Um, I know, as I said earlier, some investment banks are making that case. And we would change our mind if we saw a big stimulus program coming out of China, but there's no sign of that either from the government or the central bank. I think to your earlier point, they want to restructure their economy and forego some growth, to sacrifice some growth to get back positives in other ways. I mean, life is not all about economic growth. So they want to make their environment greener. They want to control their internet so malicious stuff doesn't permeate through it and cause a lot of problems with teenagers. You know what I'm talking about. And India, on the other hand, maybe it'll get to the stage where those sorts of things are big issues. But for now, the government's very supportive of the new economy. And that, I think, is a major driver for India over the next 5 years, particularly on the job creation side. As these startups and unicorns continue to grow, there'll be demand for jobs from really, I don't know, electric vehicles to e-commerce and everything in between. So I think India is about to enjoy that same wonderful golden period of new economy growth that China had for the last 10 years. Unfortunately, I think for India, most of it will not be something we can take advantage of in the stock market. It'll remain unlisted. But nevertheless, the indirect effects on the economy will be just as beneficial.
So, Mark, given that all markets are at an all-time high, inflation fear is real, what should one do? If you are into equities, well, you are running the risk of a asset class which is expensive and overextended. If you are into the bonds now, well, it's a risk that interest rates will go higher. If you are into gold, you're now not making money. If you're in Bitcoin, all you are doing is that you're staring at the screen, you don't know what is next. So what should one do?
I think, first of all, we don't like bonds. I could say that with some conviction, with the exception of little pockets here and there. So that asset class basically would not be too attractive for us. Equities, I think really we might be in a blow-off phase. And the thing is that we don't know how long that could last. It could last for another month. It could last for another year. It could last for another 2 years. The bull markets are very, very powerful. They can be long lasting. I tend to err on the side of optimism when it comes to the Indian equity market, because I just think there's a confluence of positive events with banks having provision for NPAs and the bad bank being set up by the government, and banks being in a position to lend again, and then property prices no longer falling. That was a huge psychological weight on people in India over the last 7 or 8 years. And then, as I said earlier, the new economy is really booming. Indian bonds will probably be included in JP Morgan's emerging market bond index next year. And to top it all off, we're looking at earnings growth over the next 3 years to be on average 25% per year. The previous 10 years, it was only 7% per year. So I don't want to go on, but to my mind, those are all constructive and they will be supportive of equity.
Sure. So, in lieu of that, what should an ideal sectoral tilt or preference be right now? Because what one has seen is much unlike 2020, when the markets were hit by the pandemic lows and then the fabulous recovery thereafter. IT and pharma were winners. But this time around, at least in the bit of a shake-off that India equity markets have seen in the last 1 week or so, even IT hasn't been, able to withstand the fall. So what is a safe haven or a hiding place at this juncture?
Well, in equities, there aren't really any safe haven hiding places. It's a risky asset class, and there just aren't. we recommend a barbell strategy pretty much globally, and so that includes in India. So what I mean by that is, as you can imagine, when you're lifting weights, that's a barbell. And on one side, we would recommend the kind of cyclical companies that would benefit from the economy continuing to be very robust over the next couple of years. And so two that I can think of off the top of my head are financials and autos. And then on the other side of your barbell, you have the more quality growth, companies, but long-term growth. So they're looking beyond the cyclicality of the economy, and that would take us into a new economy, most certainly. And also, I think fast-moving consumer goods, because if people, the rural areas, people are feeling wealthier, and in the cities, as I said, we're looking for a job creation to be quite robust over the next few years. People generally feeling good about things. Then anyway, that's the way we would balance it.
Sure. Mark, great to get in your opinion in on the show. Good to have you on the show as always.
Thank you.